if the financial advice you followed your whole life, work hard, save money, is a lie designed to keep you poor? While you save, the wealthy are using your money to invest and collect dividends. This video exposes the rules they play by, rules you were never taught. If you feel like you're doing everything right but still getting nowhere, you're not wrong, you're just playing the wrong game. Stay tuned to learn how to change the rules and finally get ahead. A banker lends you an umbrella when it's sunny and takes it back when it rains. It sounds like sarcasm, but it perfectly captures how the financial system treats the middle class, especially once they reach middle age. While hardworking people carefully save every dollar and deposit it into the bank, earning just 0.5% interest, those same banks are lending that money out at 25% APR. The savers are barely rewarded, while the borrowers carry the crushing weight of compounding interest for years. This isn't a system built to protect the average person. It's a profit machine fueled by financial ignorance. And the saddest part? This isn't taught in schools. No one explains it to you when you sign your first loan agreement. Many people only wake up when they retire, when their savings no longer keep up with inflation and medical bills start piling up. But it's never too late. The most important realization is this: this system wasn't built for savers. It was built to serve investors. And you can learn to become one of them, starting today. 1. Reckless spending makes banks richer and you poorer. Here's a financial truth most people don't want to hear. Every time you swipe your credit card without a plan, you are not just buying something, you are actively making your bank richer and yourself poorer. This isn't about a $1,000 luxury purchase. The real trap is far more subtle. It's financing a new car over 7 years. It's using buy now, pay later. It's paying for your groceries with a credit card because you're a little short this month. These small, seemingly harmless acts are the gears of a machine designed to keep you in debt. If you're in your 40s or 50s, juggling kids' tuition and retirement planning, they are your perfect customer. Those offers for 0% interest or reward points are not gifts, they're bait. While you're chasing points for a free flight, the bank is cashing dividend checks paid for by the crushing interest rates on your ballots. Think about that new $45,000 car. With a 7-year loan, interest, and higher insurance, it becomes a $60,000 trap. After 7 years, you've paid a fortune for an asset that's now worth a fraction of its price. The bank won, you lost. Even worse is using credit for daily essentials. When you can't pay the balance in full, you are essentially financing last week's dinner at 25% interest. You work hard all month just to send a portion of your hard-earned paycheck back to the bank. They get richer from your labor. So here's the rule. It is simple and it is non-negotiable if you want financial freedom. If you cannot pay your credit card balance in full every single month, you must stop using it immediately. Switch to a debit card. Use cash. It may not feel as convenient and you won't get any perks, but you will escape the debt trap that has millions of Americans struggling to breathe. The real reward isn't points. It's peace of mind. It's debt-free living. It's the ability to sleep at night knowing you owe no one. Build an emergency fund so a broken-down car doesn't become a financial crisis. This is your shield. This is how you take back control. The banking system isn't going to change. It's designed to profit from you. But you can change. So ask yourself this question every time you reach for that card. Am I buying something I need, or am I selling a piece of my financial future?
2. Your money isn't really sitting in the bank. You walk into a bank and deposit $500. You get a receipt, log into your app, and see the balance. It feels safe, secure. But here's the shocking truth the banking system is built on. The moment you leave, your money is already gone. It's not in a vault. It's been put to work for them. This is made possible by a mechanism called fractional reserve lending, and it's how banks create money out of thin air. Here's how it works. You deposit $100. The bank keeps $10 and lends out $90. That $90 is deposited into another bank, which keeps $9 and lends out $81. Your original $100 is multiplied across the economy, creating debt and generating interest profits for the banks at every step. This financial sleight of hand has a terrifying weakness. If everyone wanted their money back at once, the bank wouldn't have it. This is a bank run. We saw it in 2008. We saw it again with recent regional bank collapses, where thousands asked the same panicked question, where is my money? This is a critical wake-up call, especially for those in their 40s and 50s. You've worked your whole life, trusting the bank to protect your future. But while your savings earn pennies, eaten away by inflation, the banks are using your money to report record profits. They are getting rich from your trust. But what if you stopped letting them? What if you took your money out of their system and put it into your own? People are waking up. Instead of letting their cash sit idle, they are moving it to places where it works for them. They're opening high-yield savings accounts that crush traditional rates. They're building an investment strategy with stocks and ETFs. They understand that true financial security doesn't come from a bank balance. It comes from having your money actively build your wealth, not someone else's. You don't need to pull all your money out and hide it under the mattress, but you must understand the game you're in. Ask yourself these 3 questions. Where is my money really? What is it doing for me right now? Am I letting others get rich off my hard work? In today's world, financial knowledge is not optional. It's survival. You can't change the system, but you can change how you interact with it. And that changes everything.
3. Your banker is not your financial advisor. For many middle-aged Americans, banks have long represented stability, trust, and professionalism. When it comes time to buy a home, trade in a car, or think about investing, people often turn to bankers for guidance and advice. But here's the quiet truth. Your banker is not your financial advisor. They have no obligation to make you wealthier. They have no responsibility to protect your financial goals. At the end of the day, they are simply debt salespeople working on behalf of the bank. Some who've worked within the banking system have started speaking out. In the comments section of recent financial education videos, one person wrote, "I used to be a banker. We weren't taught how to help clients save or invest. We were pressured to sell. Credit cards, loans, refinancing. Every sale helped us hit our quotas." That admission exposes a harsh truth that many still overlook. Bankers are not there to secure your financial safety. They're there to help the bank profit from you. When you ask a banker how much you should borrow for a house, their answer will likely be the highest amount you qualify for, not the amount that actually makes sense for your situation. They're not asking whether you're supporting kids in college, still paying off a car, or getting ready to retire. Bigger loans mean bigger deals, faster signings, and higher profits for the bank. A $500,000 mortgage will earn the institution, and often the banker, more than a $300,000 one. That's where their interests lie. And it doesn't stop at mortgages. The same logic applies to credit cards, auto loans, personal loans, and refinancing packages. Every financial product is a revenue stream carefully designed to benefit the bank. Bankers are trained to sell these products. Unlike a certified financial advisor, they are not bound by any legal duty to act in your best interest. In the U.S., a fiduciary financial advisor is held to a strict ethical standard. They are legally required to put your interests first. They do not earn commissions from selling specific investment products. That means their guidance is typically far more aligned with your financial needs than anything you'll hear across a banker's desk. Unfortunately, many people still confuse the 2 roles. When shopping for a house, they walk into the bank and ask, "How much can I borrow?" When buying a car, they ask, "How much am I approved for?" But these are the wrong questions. The right ones should be, "What do I actually need?" and "How much can I safely afford without sacrificing my long-term financial health?" Consumer decisions based on borrowing capacity instead of actual needs are a major reason so many middle-class families struggle with debt as they near retirement. They live in homes that are too large, drive cars that are too expensive, and spend decades servicing loans just to maintain a lifestyle funded by credit. Meanwhile, the banker who closed their deal met their sales target, and that debt, it may have already been sold off into the financial markets for someone else to profit from. To avoid falling into that cycle, consumers must change how they approach financial decisions. Don't confuse a banker's personal kindness with the intentions of the system they work for. Yes, the individual sitting across the desk may be courteous and professional, but they are still part of an organization built to prioritize revenue, not your financial well-being. If you don't understand this, you risk making decisions that hurt you in the long run. The first step is to start asking the right questions. Do I really need to borrow? Can I afford this without stretching myself thin? Will this bring me closer to my long-term financial goals? If the answer isn't clear, pause. The second step is to seek guidance from someone truly committed to your future. A fiduciary financial advisor, someone certified and ethically bound, is the right choice if you need help building a retirement plan, managing debt, or growing your investments. They work for your benefit, not for a quota. For those approaching retirement, this stage of life is too critical for financial missteps. You don't have another 30 years to recover. Every decision needs careful consideration. Every piece of advice should be weighed against one core question. Is this person acting in my best interest or theirs? Remember, your banker is a product salesperson, not your financial doctor. The responsibility to protect your future, your home, Your retirement, your peace of mind lies with you, not them. It's time to stop handing over major decisions to people who bear no consequences for the outcomes. It's time to find someone who truly stands in your corner, not someone who just wants your signature on another loan agreement. Because in this system, the people who understand the rules will move safely, and those who don't will pay the price.
4. Banks don't follow their own advice. What if the most common financial advice you've ever heard is a lie? Save money to get rich. We've all been told this, but the banks telling you this don't follow their own advice, and there's a reason why. Here's the harsh reality. You deposit $1,000 into a savings account, and they promise you 0.5% interest. The moment you walk away, the bank takes your $1,000 and lends it to someone else for a car or on a credit card at 20% interest. They make a massive profit. You get pennies. It's time for a new rule. Saving doesn't make you rich. Investing does. Saving is a tool for 3 things only: an emergency fund, saving for a big, short-term purchase, temporarily holding cash before you invest it. If your life savings are sitting in a regular savings account, you are not saving, you are losing. With inflation at 3 to 4% a year, your money's buying power is being eaten alive, day after day. You are literally getting poorer while thinking you are being responsible. So why do banks keep telling you to save? Because they need your money. Your savings are the cheap raw material they use to generate massive profits. They don't want you to know the game. But you can change your strategy today. Treat saving as the preparation stage and investing as the main event. You don't need a lot of money to start. Start by moving your emergency cash from a regular bank to a high-yield savings account. You could earn 10 times more interest instantly. Then open a brokerage account, it's free, and start learning about simple investments like index funds. Put the rest of your money to work, generating passive income for you, not for the bank. Banks don't get rich by saving. They get rich by investing your money. Now it's your turn to do the same, but this time for your own financial freedom. Stop letting your money sleep. It's time to wake it up and put it to work. Alternative solution. Become the owner, not the victim. If you're in your middle years and have long believed that disciplined saving is the guaranteed path to financial freedom, it's time to take a hard look at the system operating around you. Because the truth is, the modern financial system doesn't reward savers. It's designed to benefit those who invest, who own, and who know how to make money work for them. And unless you change how you handle your money, you'll spend the rest of your life fueling someone else's profits. One of the biggest myths out there is that investing is only for the young or the wealthy. But the reality, many people in their 50s and 60s are just beginning their investment journeys, starting small and slowly building a stable financial foundation. Investing isn't gambling. It doesn't require a finance degree or hundreds of thousands of dollars in your account. What it does require is consistency and a shift in mindset. Start with simple tools suited for people in your life stage: mutual funds, exchange-traded funds, or ETFs, and dividend-paying stocks. These options don't require you to pick the right stock or watch the market daily. Many platforms today let you invest in small amounts, even as little as a few dollars a week, so you can build your future without disrupting your budget. And no, you don't have to know everything before you begin. Nobody is born a savvy investor. Financial knowledge comes from experience, and experience begins the moment you start. Many avoid investing because they fear making mistakes or losing money. But here's the real danger: keeping all your money in a savings account earning 0.5%, while inflation quietly erodes 3 to 4% of your purchasing power every year. That's a loss you may not see, but it's happening. Some people are getting creative with investing. For example, several have started using credit card cash back to buy bank stocks, turning short-term rewards into long-term assets. Instead of spending that money, they're accumulating it and reinvesting in the same companies that profit from their spending. It's a smart way to flip the system from consumer to owner. Another safe and simple move is transferring idle money into high-yield savings accounts. These online accounts can offer 4% or more in interest, significantly higher than traditional banks. If you're not ready to invest just yet, this is a great first step to preserving your cash. You might also consider moving your money to community banks or credit unions. These institutions prioritize member benefits over shareholder profits. They often offer lower fees, better rates, and less pressure to sell debt.
It's a small change that puts more control in your hands. Every one of these steps, from small ETF investments to using cashback wisely, is about shifting your position in the financial system, from being the person who pays interest to the one who earns it, from losing value to inflation to gaining dividends, from a passive participant to an empowered investor. Because here's the truth, this system isn't built for consumers, it's built for investors. If you're a consumer, you pay interest, fees, and suffer the slow loss of purchasing power. If you're an investor, you earn dividends, grow wealth, and leverage compounding. These are two very different worlds, and you can choose to step into the second one anytime. Too many people in their 50s and 60s have missed opportunities because they thought investing was too risky or too complicated. But that's simply no longer true. With modern tools, easy-to-use platforms, and free financial education at your fingertips, you can start with your phone today. The key is to change your mindset. Stop seeing money as something to stash. Start seeing it as something to use. If you learn how to manage your money well, it will work for you, even while you sleep. No one achieves wealth by working and saving alone. The people who reach financial freedom are those who own things, stock in companies, real estate, income-generating assets. They don't spend their lives paying bills and waiting for the next paycheck. They make their money work harder than they do. And that's not a privilege, it's a choice. You can start today, maybe small, but steady. Don't let age or lack of knowledge stop you. Every financially successful person was once a beginner. What changed their lives? They started, and so can you. No permission needed, just a decision. From this moment on, look at money as a tool you control. Don't be a victim of a system designed to exploit what you don't know. Become the owner of your money and of your future. Remember, if you're not owning assets, you are the asset. The system is designed that way, but your awareness is the first step to beating it. You don't need to be rich to start, just determined. If this message resonated, help others see the truth by sharing this video. Subscribe and hit the bell for our free daily newsletter, packed with simple, practical knowledge. Don't just watch, act. Your financial freedom begins with this decision.